Hello, my name is Joe Hoyle, and I'm one of the co-authors of your financial accounting textbook. In this video, we're going to look at the statement of cash flows. We're going to talk about investing activities and financing activities, and we're going to spend a lot of the time looking at the operating activities, and we're going to use the indirect method in this video to show how much cash the company generated from its operating activities. A company must report a statement of cash flows, and that statement of cash flows will have three clear sections. It will have operating activities, it will have investing activities, and it will have financing activities. So if you go to the internet and you look up any company you wish, and you look at the statement of cash flows, you will find those three sections. What do they mean? Well, operating activities means that this is cash that was generated by producing and delivering products or services. In other words, this is the cash that the company got from its primary business operation. If you're in the business to make pizzas and deliver them, then anything that you get from selling pizzas or selling salads or selling soft drinks would fall under operating activities. Likewise, the rent expense, the insurance expense, the salary expenses would all be part of normal operating activities. As we have said in other videos, that figure is a very, very important number when you're looking at a set of financial statements. You'll also see, though, on the statement of cash flows, investing activities. These are cash flows that come from non-operating activities. They are not part of producing and delivering services or products. It's something slightly different than the day-to-day activities of the business. But if it's an investing activity, it has to involve an asset. So if you buy, for example, a piece of land, unless you're in the real estate business, that's going to be an investing activity. It's not part of the day-to-day operating activities, and it involves an asset. And then the third section of the statement of cash flows is the financing activities. Financing activities, like investing activities, are non-operating in nature. They're not part of the daily operations of the business to produce and deliver services and products. But in this case, they involve either a liability, for example, a bond payable or a note payable, or an equity account, such as treasury stock or a cash dividend or common stock or preferred stock. So there's a lot of information that you will find on a statement of cash flows, but it's important to understand that it's all divided into three sections: operating activities, the daily activities of the business, part of the normal operations of the business; investing activities, it doesn't qualify as operating activities, and it involves an asset. And then finally, the financing activities, again, it doesn't qualify as operating activities. It's not operating, but it involves either a liability or a stockholders' equity account. So that's what we're going to look at. So let me give you a couple of examples. Let's assume that you and I start a donut shop, and we're going to create the statement of cash flows. If you take the cash amounts that you receive from selling donuts or coffee, what you typically get in a donut shop, those are operating activity cash flows. Very clearly, that's part of your normal business activity. The same is true for paying salaries or rent. Those are operating activities. I don't think there's anything at all difficult or tricky about that. We just qualify them or classify them as operating activities. Secondly, if we paid for a delivery truck, maybe we have a truck to deliver our donuts to customers, or we receive money because we sell a refrigerator. We have a refrigerator we don't need and we sell it. Neither of those two events are part of operating activities. They don't happen on a day-to-day basis. They are not in dealing with a customer, and they're not part of delivering goods or services. They are not operating. In each case, they involve an asset, either a truck in the first case or a refrigerator in the second case. Therefore, they are viewed as investing activities to separate them from operating activities. And then finally, if we distribute a dividend as cash, that's not part of our operating activities. That's not part of our daily business. Or if we issue a bond and receive money from that, again, that's not part of daily operations. Those both are non-operating, but since the dividend is an equity account and the bond is a liability account, we would find these as financing activities. That's how they would be shown on our statement of cash flows. We're getting you used to being able to analyze this very, very important financial statement, the statement of cash flows. So let me just give you a couple of examples here. Let's assume you look, now notice I'm leaving the operating activities off. I'm going to do those separately. I'm just looking at financing activities and investing activities. And what we do is we will group these. So if they give several dividends, we will simply list cash distributed as dividends. We paid $340,000. Cash received from the issuance of common stock. That might have been one time or it might have been 5 times. We received $225,000. Cash paid on long-term debt. We apparently were paying off some of our long-term debt. That was $110,000. And notice, and I like this about the statement of cash flows, that's very clear. You can look at that and you can see exactly what happened and how much cash either came into the company or left the company. Investing activities, of course, they're going to have an asset. Cash paid to buy new trucks, $300,000. Cash received from sale of land, $430,000. Again, non-operating, but this time they are dealing in assets. They're dealing in a truck or they're dealing in land. So as far as the financing activities or the investing activities, what you're looking for, I think, is pretty obvious. How much cash did you get or how much cash did you spend? Does it involve an asset or does it involve equity or a liability? And the information is simply presented so that decision makers can understand what happened to the company this year. Now we'll move to the operating activities, a more complicated section. And we've already talked in another video about operating activities, and this follows through with that. You'll remember from the previous video that the operating activities can be done by either the direct method or the indirect method. It will not change the total amount. If the company received cash this year of $339,000, then however you prepare it or however you present it, it will be $339,000. It's just that the presentation will be different. We already know from our previous video that FASB prefers the direct method because it provides clearer information. It tells you where the money came from. It tells you where the money went. However, if you go into the real world, as I sometimes call it, you'll find that virtually all companies use the indirect method. So it's very important, if you're going to be a business person, that you understand how the indirect method is created and what information it is conveying, because the indirect method is certainly the method that you're most likely to see out in the real world. If we're using the indirect method, as always, there will be 4 steps. We will start with net income. Now, when we did that for the direct method, we used the entire income statement. Here we will use just net income. We'll remove any non-cash amounts. And we already know that the non-cash amount that's the most common is depreciation expense. We will also remove any non-operating items because they do not affect operations. And we already know that the most common of those are gains and losses, and we will remove those. That's no different than what we've done before. The final step is that we'll take whatever numbers remain and they will be in accrual accounting. Accrual accounting guides when the recognition takes place. For example, revenues are recognized when the performance obligation is satisfied. That's according to accrual accounting. So what we want is not the remaining numbers in accrual accounting. We want the remaining numbers in cash accounting. And that to do that, we're going to take the balance sheet connector accounts, the ones that tie the income statement accounts from accrual accounting to cash accounting, and we're going to use those to convert from the accrual numbers to the cash numbers. So as we've done before, we might make a sale on Monday. It will be reported on the income statement on Monday. If we collect the cash on Saturday, then for the statement of cash flows for the operating activities, it should be recognized on Saturday. How do you get the income statement number to the number that you want for the statement of cash flows? Well, you determine how the connector account has changed. And for a sale, as you already know, I hope, that connector account is accounts receivable. And we will use that then to take this accrual number and get it into a cash number. So the 4 steps are the same as we've done before, but they will certainly look different. The first one is we will take net income. We will eliminate the non-cash items. We'll eliminate the non-operating items. And then we will adjust the accrual accounting numbers to cash numbers using the change in the balance sheet connectors. And remember, as I just said, it is that change that you want. If a connector account such as accounts receivable goes up, that means you collected less cash. That tells you what happened to cash. If salary payable goes down, that's a liability. If it goes down, it means you paid more cash. So we're always looking for the impact on the cash account when we look at these balances, these connector accounts that we will have from one year to the next. I want to remind you that some of the main connector accounts that you will encounter. If you have sales revenue, the connector account is accounts receivable. If you have salary expense, the connector account is salary payable. If you have rent expense, the connector account is rent payable or possibly prepaid rent, depending upon whether you pay in advance or pay after the time period. And for cost of goods sold, you always have 2, and that makes it a little more tricky. You have inventory and accounts payable. Those are connector accounts. They are going to be used when we convert from accrual accounting to cash accounting in order to get the operating activity cash flows. So we're going to use an example here. What are the 4 steps? We will not start with an income statement in the indirect method. We will start with net income. It will simply be a one single number. We don't have to worry about the entire income statement. That's one of the reasons that companies like it. It only starts with a single net income number. We will remove the non-cash balances. And again, to be repetitive, the main one of those is depreciation expense. Now, when we did this with the direct method, we simply just omitted it. We just left it off. That was easy. Here we have to do something a little different. The depreciation expense is inside net income. Clearly, depreciation is in net income. We want to remove it. If it's a negative, then of course depreciation expense would be a negative, then we have to add it. That offsets it, that eliminates it. If it had been, for example, a positive, then to eliminate it from net income, we would have had to subtract it. That's an important thing to remember when you're dealing in the indirect method. If the number in net income is a negative, you have to add. If it's a positive, you have to subtract. The same is true for any non-operating balances such as gains and losses. The positives are subtracted, the negatives are added back. And then we will do the adjustments for all the accrual accounts. The steps remain the same as we've done before. They're just going to look different. So let's see if we can take an example and make it work. You may remember this example from a previous video. Ace Company has the following income statement accounts: sales $700,000, rent expense $50,000, salary expense, 120,000, cost of goods sold, 300,000, depreciation, 60,000, the gains, 40,000. Absolutely nothing odd or unusual about that. That looks like a very typical income statement. If you do the math, the net income is 210,000. We're going to begin by removing both the non-cash, and of course the non-cash is going to be the depreciation expense, and the non-operating, which is going to be the gain on the sale of land. We're going to eliminate those first. There's your income statement. There's your accounts. We're going to eliminate the non-cash depreciation and the non-operating gain. And notice how I do that. I come over here and I don't just erase them or leave them off. I actually have to physically remove them. So depreciation expense is in net income. It's in that net income number right there, but it's in that net income as a negative. So if you want to eliminate it, then you have to add it back. These two things offset each other and eliminate the depreciation. The gain on sale of land is also in the net income number, but it's in the net income number, it's a gain, as a positive. So if you want to eliminate that positive, then you have to subtract it. If you can see why I add depreciation to eliminate the negative and why I subtract the gain to eliminate the positive, then you've gone a long way in understanding how the indirect method is created. That's a strong part for creating the indirect method. All we have left, and I say that almost humorously, is we have left the accrual accounting numbers. We have left sales and rent expense and salary expense and cost of goods sold. They're all what's left in net income because we've eliminated depreciation and the gain. We're now going to look at the changes in the connector accounts, and we're going to then use those to adjust back to cash balances. Accounts receivable went up 30, prepaid rent went down 10, salary payable goes up 50, inventory goes down 40, accounts payable goes down 15. Nothing odd about that, just typical changes for those connector accounts. And we're now going to factor those in, those changes, one step at a time. So let's do them one step at a time. And the first one is account receivable went up $30,000. If account receivable goes up $30,000, that means that we collected less. As long as you don't collect anything, your account receivable will go up. To switch from accounts receivable, from accrual accounting to cash accounting, that increase, that collection less, must be factored in. We increased account receivable. What that means is that we collected less cash. And since we collected less cash, we have to subtract out the $30,000. That's what you'll see. If you look up a statement of cash flow on the internet from some company you might be interested in, you're going to see that because that's how the indirect method works. We have first, as you can see, removed the depreciation expense, and then we removed the gain, and then we adjusted, because we're moving from accrual accounting to cash accounting, we adjusted the increase in accounts receivable. Why did we subtract it? We subtracted it because that increase in accounts receivable means that we collected less. And if you collect less, you will have less cash. That just makes sense. That's our first accrual balance sheet connector adjustment. And we will simply go through the rest of them just like that. Rent expense was $50,000. It went down 10,000. If you've got prepaid rent and it goes down by $10,000, why does prepaid rent go down? Prepaid rent goes down because you paid less. That's why any prepayment would go down. You simply pay less. Therefore, if you pay less, and this is the logic I want you to get used to, That saves you $10,000 in cash, and that increases your cash account. So what we're going to do, and I'm not going to repeat this every time, is we're going to add to the operating activity schedule that we've been building that decrease in prepaid rent. We paid less, we saved the money, we're going to add that in. And that's the logic that you kind of develop on these things. And that is prepaid rent went down, I paid less. If I paid less, I have more money. And if I have more money, I need to add in the $10,000. Salary expense was 120. Salary payable, our connector account went up 50,000. So salary payable goes up $50,000. What is the effect upon cash? If your liability increases, it increases because you paid less. That's why any liability would go up, because you paid less. If your liabilities go up and you pay less, that means you've got more cash. Paid less means you've got more cash. That's what paid less would be. So when we're doing our adjustment, the increase in salary payable is added. More cash, 50,000 is added. That's how that connector account is factored in to our computation of the indirect method. Let's do one more. We're now going to do inventory. This is cost of goods sold, of course. And with cost of goods sold, you have two connector accounts. You have inventory and you have accounts payable. So we're going to do both of them at the same time. Inventory in this case went down. So therefore, if the inventory goes down, that means that you bought less. I think that, again, is just logical. If inventory goes down, it goes down because the company bought less. If they bought less, that saves your cash. And that allows the company to add the 40,000 to its cash balance. The decrease in inventory, you bought less. And if you bought less, what is the effect upon cash? It means that the cash is saved. And if you save cash, that decrease in inventory saves your cash, you will add that. And our final account is that accounts payable went down 15,000. You have accounts payable, it goes down 15,000. Just stop and ask yourself, why does the liability go down? Why does the liability go down? A liability goes down because you pay more. Well, then ask yourself, if you pay more, what's the impact on cash? Well, if you pay more, your cash will go down also. That's what causes the account payable. So when we have that decrease in accounts payable, we have to subtract. We're taking each of those connector accounts. Luckily, in most cases, there's only going to be 4 or 5 or 6 of the connector accounts. It's not like you're having to work with 50 or 60 of them. You're only going to be working with 4 or 5. You'll need to practice. It takes you a while to get used to this. If accounts payable goes down, what is the impact on cash? If inventory goes down, what's the impact on cash? But if you practice this, oh, you'll get very good at this very quickly. So we have gone through, and now what I want to do is to actually show you using the indirect method. Now, FASB would argue, I suspect, that this is harder to follow. Remember, in the direct method, it said cash received from customers and gave an amount, cash paid to employees and gave an amount, cash paid for inventory and gave an amount. That was considered to be clear information. This is different. You start with net income, you remove the depreciation, and you remove the gain on sale of land. The depreciation was in here as a negative, so you added. The gain was in here as a positive, so you subtracted. You then have all of your accrual accounts, and we have 5: accounts receivable, prepaid rent, salary payable, inventory, and accounts payable. In each of those cases, we look to see, did it go up or did it go down? And what we were interested in was, how does that affect cash? Sometimes it affects cash that you collected. Sometimes it affected cash that you paid. But how did it affect cash is what you're looking for. And then we factor that change in over here, and that changed the accrual accounting balances in net income to cash balances. And the amount of cash we receive from operating activities is $285,000. I won't try to fool you. That is not an easy computation. It does take practice. College classes can be challenging. And I think of all the things in this financial accounting textbook, this is one that clearly is a challenge, but you're capable of doing it. But you're capable of doing it only if you'll do a good amount of practice. Use your textbook or other information that you have. Practice the indirect method, because this is the method that you're going to see in real life. And you want to get used to, when you see something like this screen here, you want to have a good, strong understanding of where these numbers came from. Clearly, the number that's the most important is the bottom number. How much cash did Ace Company get from its operating activities? And in this particular year, it received $285,000. That's important information. My name is Joe Hoyle. I'm one of the co-authors of your financial accounting textbook. It has, as always, been a wonderful pleasure working with you.